There is one hotel stock on my watch list and it looks like there is a lot of growth potential. Now, as an investor, I usually do not like the hotel/hospitality business because they face difficulties in their operations and also they struggle to generate cash flows. But the stock that we are going to discuss today seems to be an exception. There is some sort of upcycle that is happening in the hospitality sector, and this company is taking really good advantage of that and also generating cash flows. Now, it is not the kind of hotel that you find on OYO because there is a premium brand play. It is the largest hotel player in India and bigger than companies like ITC and Marriott in the domestic market. The name of the stock is Indian Hotels Company Limited, and I'm sure you must have heard of Taj and Vivanta. Taj is one of the strongest hotel brands in the entire world. So this is the company, and for those of you who are not aware, let me tell you that this entire company is a subsidiary of the Tata Group. So in this video, we will be looking into the company's financials and try to find out if they can win big in the hotel/hospitality industry. And please remember, whenever I say positive things about a stock, it does not mean that I am recommending it. Retail investors can look for similar positives in any stock of their choice and can make a decision for themselves. So without wasting any time, let's get started. Namaste and welcome to Retail Investing. So here is the chart, and as you can see, the stock has gained a lot since February, but in the last few weeks it has corrected a bit. The daily traded volumes are high, which means there is interest in the stock. Now before we get into the financials, let's have a look at the kinds of businesses that Indian Hotels is into. There are brands and sub-brands like the Taj, Vivanta, Selection and Ginger. Now these belong to the premium and luxury category, but Ginger is a budget-friendly option. Now, one of their business segments is called Qmin, and it is a food delivery platform. To be more precise, we should call it a gourmet delivery platform. Now, gourmet is not normal food. It is of refined taste and it is sensuous. So this is also a premium brand play. While Swiggy and Zomato are fighting their price wars, Qmin is playing a totally different game. There is another segment named Amma, which provides tourists with private bungalows and villas at niche destinations. The demand for this segment is growing because the rich are growing. The segment Selections deal with signature city hotels and leisure resorts. So here is the financial overview. The market cap is 55,417 crore rupees. So this is a mid-cap company. A large-cap company is like an elephant which is very heavy and moves slowly. In sharp contrast, a small-cap company is like a cheetah and it moves very fast. While the mid-caps are somewhere in between and resemble a rhino. The price to earnings multiple is 50.4 against the industry average of 32.4. Now when it comes to peer comparison, I am least bothered about its price to earnings multiple being higher than the industry average because the companies from which the industry average has been derived do not seem to be strong competitors. The return on capital employed is 12.6 and the return on equity is 12.7. Now these numbers are not impressive by any means, but in the future when the earnings go up, these numbers are also likely to go up. So the company has a debt of 2,718 crore rupees and its reserves are 8,142 crore rupees. The debt to equity ratio of 0.33 is quite low. The current ratio is 1.21 and the quick ratio is 1.14. So it passes the basic safety checks. Now the price to earnings growth ratio of 0.86 makes the stock look attractive. Now let me show you one interesting thing about the sales. As you can see, in the September 2020 quarter, the sales were 257 crore rupees. The same thing happened again in the next financial year. In the June 2021 quarter, the sales were 345 crore rupees, and by December 2021, it almost went up 3x again. So why is that happening? It's mainly because weddings happen in the winter season and also many events take place during that time. Now nobody likes summers, and as we all know, winter is coming, and when winter comes, revenues go up. The hospitality sector in India is severely underpenetrated. Let's have a look at some data. So here we have some data on per 1,000 people from around the world. As you can see that the global average for branded rooms per 1,000 people is 2.2, while for India this number is only 0.1. For China it's 3.2, which is above the global average, and for America this number is 16.3. So in a severely underpenetrated sector like this one, there are chances of upcycles happening. But is it actually happening? Let's have a look at some more data. So over the next 5 years, the expected growth in demand will be at a CAGR of around 10%. But the supply is expected to grow only half that number, which is only a CAGR of 5 to 6%. A situation like this creates a lot of profit-making opportunities for the strong companies. So this data is quite exciting. Big growth is coming from the Tier 2 and Tier 3 cities. In the non-luxury segment, 29% of growth will come from the Tier 2 cities and 44% from the Tier 3 cities. And in the next 5 years, 2.2 lakh rooms will be available. Now, I personally look for investing opportunities in those companies which target markets like rural India, small towns, and the Tier 2 and the Tier 3 cities. That's because the Tier 1 cities like Mumbai and Bangalore have already grown too much. So number one is the growth in tourism. The hotel/hospitality sector is directly correlated to the tourism sector. In fact, it is called a part of the tourism sector. Post-COVID, the tourism sector has seen a massive boom in India and it is expected to continue. Number two is the big events like the Cricket World Cup and the G20 Summit. And also there is the wedding season which drive up demand, which increases the revenues and the profit margins for the company. Number three is the brand value of Taj. And Taj has already established itself as one of the strongest hotel brands, not only in the domestic market but also globally. Number 4 is the food and beverages business. Roughly 35% of the revenues come from this segment and it is a high margin business. They have an ancillary business called Taj Sats, and Taj Sats operates in the airline catering business and they are the market leader with 58% market share. Number 5 is the company's strong cash flows relative to its peers and its debt-free balance sheet. The biggest threat that I can imagine is a pandemic-like situation. What if our neighbor decides to export another pandemic to the world? It's game over. There will be no traveling, no tourists, and no demand for hospitality. Number 2 is restrictions on international travel due to geopolitical and diplomatic reasons. We often see that countries like to give advisory to their citizens to not to travel to a particular country. Now it happens when diplomatic relations go downhill and it can severely affect the revenues. And number 3 is seasonality. Now it's quite clear that there is some sort of seasonality involved in this business. The revenues do not grow consistently but go up only during a particular season. So as of now, it looks like it is a thematic stock which can do well for a few years in the future, but it does not appear to be a consistent compounder kind of stock. Now recently, the stock has corrected significantly, but the technicals still suggest bearishness, but the fundamentals look good. Don't forget to type in the comment section what are your views on Indian hotels and the hospitality sector in general. Please don't consider any of this as investment advice. This video was only for educational purposes. You know, the stock market is a game of demand and supply. So if you can create enough demand in the comment section for a stock, I will supply you with the analysis. Thank you very much for joining and I'll see you in the next one. Jai Hind.